It happened at 3:47 a.m. Eastern Standard Time. A single transaction, one wire transfer that lasted 14 seconds. But those 14 seconds just triggered the largest institutional exodus from the dollar system in American history. Ladies and gentlemen, I need you to understand what happened in the early morning hours this week. What I'm about to tell you won't be reported in the mainstream financial media. It won't appear in Federal Reserve communications. It won't be discussed in congressional hearings. But it has already started a cascading institutional abandonment of the dollar that cannot be reversed. Here's what happened. At exactly 3:47 a.m. EST, the Federal Reserve's automated settlement system processed a routine transaction from a major European pension fund. They were attempting to purchase $75 billion in U.S. Treasury bonds to rebalance their portfolio. Standard procedure. Happens hundreds of times per week. But the transaction failed, not because of insufficient funds, not because of technical errors, not because of market volatility. The transaction failed because the Federal Reserve's settlement system could not locate $75 billion worth of Treasury bonds to deliver. Think about what that means. The most liquid market in the world, the market that underpins all global finance, the market that the Federal Reserve claims has infinite depth and infinite supply, could not fulfill a standard institutional order. The U.S. government bond market, the foundation of the dollar system, experienced a delivery failure. The European pension funds' portfolio managers initially assumed it was a temporary glitch. They waited 30 minutes and tried again. Same failure. They waited 2 hours and submitted the order through different primary dealers. Same failure. By 8 a.m. Eastern Time, when global markets opened, word of the delivery failure had spread through institutional trading networks like wildfire. By noon, 17 major institutional investors had experienced similar failures attempting to purchase large quantities of Treasury bonds. Pension funds from Canada, Denmark, Switzerland, insurance companies from Japan and Singapore, sovereign wealth funds from Norway and Australia, all reporting the same problem. They could send dollars to the Federal Reserve, but the Federal Reserve could not deliver the Treasury bonds they were trying to purchase. The Federal Reserve's response was swift and panicked. Within 6 hours of the first delivery failure, Fed officials contacted primary dealers and demanded explanations. What they discovered was a crisis that had been building for months, but only become visible when institutional demand exceeded physical supply. The internal Federal Reserve investigation revealed horrifying details about the Treasury market's actual structure. Goldman Sachs, J.P. Morgan Chase, Bank of America, the primary dealers responsible for Treasury market liquidity, had been operating what amounted to a sophisticated Ponzi scheme. They were selling Treasury bonds to institutional clients, while simultaneously borrowing those same bonds from other institutional clients to fulfill previous sales. The Federal Reserve's own records showed that over the past 18 months, primary dealers had sold $2.3 trillion more in Treasury securities than the Treasury Department had actually issued. The difference was made up through complex rehypothecation arrangements, where the same physical bonds were pledged as collateral for multiple transactions simultaneously. When European institutional demand hit $75 billion in a single transaction, the entire shell game collapsed. There simply weren't enough physical Treasury bonds in existence to fulfill all the promises that had been made to institutional buyers. The Federal Reserve discovered they were managing a paper market that had lost all connection to underlying assets. The Treasury bond market, the most important financial market in human history, had become a paper market backed by promises rather than actual securities. Primary dealers had been selling bonds they didn't own, assuming they could acquire them from the Federal Reserve when needed. But the Federal Reserve had been creating digital entries in their system without printing corresponding physical bonds. In essence, the Treasury market had become a fractional reserve system where far more bonds had been sold than actually existed. When European institutional demand reached a certain threshold, the entire facade collapsed in real time. The implications were immediately clear to sophisticated institutional investors. If the Federal Reserve cannot deliver Treasury bonds, the most basic building block of the global financial system, then the entire dollar-based monetary framework is built on air. The safe haven asset that has anchored portfolio theory for 50 years doesn't exist in the quantities that have been sold. But here's where the story gets truly extraordinary. Instead of creating panic, instead of triggering market crashes, the institutional response was coordinated, systematic, and devastating to American monetary supremacy. They didn't dump their existing dollar holdings and create chaos. They quietly began rotating away from dollar-denominated assets without fanfare. The Norwegian government pension fund, the world's largest sovereign wealth fund, issued internal guidance within 12 hours of the Treasury delivery failure. New investment flows would be redirected away from U.S. government bonds toward European real estate, Asian infrastructure projects, and commodity-producing assets. They didn't sell their existing Treasury holdings, which would have created market volatility. They simply stopped buying new ones. The Canada Pension Plan Investment Board followed within 18 hours. Internal communications, leaked through parliamentary oversight processes, show that Canadian pension managers decided to reduce their target allocation to U.S. government bonds from 40% to 15% over 12 months, not through dramatic selling, but through quiet reallocation of new contributions. But the most devastating institutional response came from Japan. The government pension investment fund, managing nearly $2 trillion in retirement assets, quietly updated their investment guidelines to allow up to 50% allocation to non-dollar assets. For an institution that has been one of the largest buyers of Treasury bonds for decades, this represents a complete strategic reversal. The speed of Japan's institutional pivot shocked American monetary officials. Within 48 hours of the Treasury delivery failure, the Bank of Japan received authorization from the Ministry of Finance to begin converting dollar reserves to yen, euros, and physical gold at an unprecedented pace. Japanese institutional investors were given explicit government approval to diversify away from dollar-denominated assets as quickly as operationally possible. Toyota, Sony, SoftBank, Japan's largest multinational corporations, received internal guidance to minimize dollar cash holdings and accelerate the conversion of American revenue into yen-denominated assets or physical infrastructure investments. When Japan's corporate sector starts treating dollars as hot potatoes rather than preferred reserves, the currency's international standing shifts fundamentally. The most shocking Japanese institutional move came from the Japan Post Bank, which manages over $1.4 trillion in postal savings deposits. They announced a complete suspension of new Treasury bond purchases and began offering Japanese depositors foreign currency accounts denominated in euros, yuan, and gold-backed certificates as alternatives to dollar-denominated savings. Within 72 hours of the original delivery failure, institutional investors managing over $12 trillion in assets had modified their investment strategies to reduce dollar exposure. Not through panic selling, but through systematic reallocation that creates permanent structural changes in global capital flows. The mathematics are terrifying for American monetary stability. When institutional investors stop buying new Treasury bonds, the Federal Reserve must step in to purchase government debt directly. But direct Federal Reserve purchases of Treasury bonds require money creation, which devalues existing dollars and makes Treasury bonds less attractive to the remaining institutional buyers. This creates the exact doom loop that sophisticated institutional investors are trying to escape. The more the Federal Reserve prints money to buy government bonds, the less valuable those bonds become to foreign holders, which forces more Federal Reserve money printing, which accelerates the devaluation cycle. The trigger event, the Treasury delivery failure, revealed to institutional investors that the U.S. government has been issuing more debt than the market can physically absorb. The Federal Reserve has been creating artificial demand through digital accounting rather than genuine institutional appetite for American government debt. Institutional portfolio managers are not politicians. They don't care about American global leadership or geopolitical stability. They care about preserving and growing the retirement savings, insurance reserves, and sovereign wealth they manage. When they discover that the safe haven asset underlying their portfolio strategies doesn't exist in promised quantities, they move money, quietly, systematically, permanently. European institutional investors are rotating toward European infrastructure projects, Asian manufacturing investments, and commodity-producing assets that exist in physical form rather than digital promises. They're not abandoning international diversification. They're abandoning American promises in favor of tangible alternatives. The European institutional pivot is being coordinated through the European Investment Bank and the European Central Bank in ways that maintain plausible deniability while achieving strategic objectives. The EIB has created new infrastructure investment vehicles specifically designed to absorb European pension fund capital that was previously allocated to Treasury bonds. French pension funds are leading the European rotation with aggressive investments in African solar projects, Eastern European manufacturing facilities, and Scandinavian mining operations. The French Public Service Pension Fund announced this week that they would cease all new dollar-denominated investments and focus exclusively on euro-denominated assets and physical infrastructure that serves European strategic interests. German insurance companies are following similar strategies, but with greater focus on Asian markets. Allianz, Munich Re, and other major German insurers are establishing subsidiary operations in Singapore, Hong Kong, and Dubai, specifically to manage non-dollar investment portfolios on behalf of European institutional clients seeking alternatives to American monetary exposure. The most sophisticated European response is coming from Swiss institutions, which have begun offering post-dollar portfolio management services to wealthy individuals and institutional clients worldwide. UBS and Credit Suisse are marketing investment strategies that assume continued dollar devaluation and structure portfolios around physical assets, regional currencies, and alternative monetary systems. Asian institutional investors are accelerating their participation in China's gold settlement network, regional development projects, and intra-Asian trade relationships that minimize exposure to dollar-denominated assets. They're building an economic sphere that functions independently of American monetary policy. Middle Eastern sovereign wealth funds are converting dollar reserves into direct ownership of agricultural land, mining operations, and energy infrastructure across Africa, South America, and Central Asia. They're transforming paper wealth into physical control over resources that maintain value regardless of currency fluctuations. The most sophisticated institutional response is coming from Swiss and Nordic pension funds, which are pioneering what they call post-dollar portfolio theory. They're creating investment frameworks that assume continued dollar devaluation and structure portfolios around physical assets, regional currencies, and decentralized settlement systems. But the institutional abandonment isn't happening through dramatic announcements or public statements. It's happening through quiet modifications to investment guidelines, gradual reallocation of new capital flows, and systematic reduction of dollar exposure over periods measured in months rather than days. The stealth approach protects institutional investors from political pressure while achieving their strategic objectives. American officials cannot criticize European pension funds for betraying alliance relationships, when those funds are simply adjusting their asset allocation parameters within normal portfolio management practices. The Federal Reserve faces an impossible choice. They can attempt to force institutional investors to maintain dollar exposure through capital controls, interest rate manipulation, or regulatory pressure, but such measures would accelerate institutional flight by confirming that dollar investments require political coercion rather than economic attractiveness. Internal Federal Reserve strategy documents leaked through congressional oversight processes reveal 3 potential response options, all of them problematic. Option 1 involves implementing capital controls that prevent American institutional investors from diversifying away from dollar assets. But such controls would destroy America's reputation as a free market economy and accelerate foreign institutional flight. Option 2 focuses on interest rate manipulation to make dollar assets artificially attractive through higher yields, but higher interest rates would increase government debt service costs beyond sustainable levels and force even more money printing to finance federal operations. Option 3 involves direct Federal Reserve intervention in foreign exchange markets to prevent dollar devaluation. But such intervention would require unlimited money creation and validate institutional concerns about American monetary stability. Federal Reserve officials have been conducting emergency consultations with former Fed chairs Paul Volcker, Ben Bernanke, and Janet Yellen, seeking historical precedents for managing institutional capital flight of this magnitude. The consensus from former Fed leadership is sobering. No monetary policy tools exist that can reverse institutional confidence loss once it reaches critical mass. The most troubling aspect of the Federal Reserve's internal analysis is their recognition that institutional dollar abandonment creates its own momentum. As more institutions reduce dollar exposure, the remaining dollar-denominated assets become riskier for the institutions that continue holding them, creating incentives for accelerated diversification rather than patient reallocation. Alternatively, they can accept institutional dollar abandonment and focus on domestic demand for Treasury bonds. But domestic American institutions lack the capital reserves to absorb the quantities of government debt that foreign institutions have been purchasing for decades. The Treasury Department has been conducting emergency consultations with allied governments, requesting diplomatic intervention to maintain institutional dollar demand. But European and Asian allies are discovering they have independent economic interests that don't align with American monetary stability. Currency markets are beginning to reflect the institutional reallocation, but not through dramatic dollar crashes that would trigger policy responses. Instead, the dollar is experiencing what currency traders call systematic erosion, where demand decreases gradually but persistently across multiple institutional categories simultaneously. Dollar strength has been maintained through Federal Reserve intervention and commercial bank coordination, but central bank officials understand they are fighting institutional flows with artificial market support that requires continuous money creation to maintain. International trade relationships are adapting to institutional dollar abandonment through increased use of bilateral currency arrangements, commodity-based settlements, and regional payment systems that minimize dollar intermediation. The dollar's role as a transaction medium is declining alongside its role as a store of value. The most profound change is psychological. For 70 years, institutional investors worldwide have assumed that dollar-denominated assets represent permanent safety and liquidity. The Treasury delivery failure shattered that assumption and forced institutional recognition that American government promises are subject to physical constraints. When institutions managing trillions of dollars in retirement savings, insurance reserves, and sovereign wealth lose confidence in the fundamental building blocks of the global monetary system, they don't wait for permission to protect their stakeholders. They move money immediately, quietly, and permanently. The trigger event, those 14 seconds of failed settlement at 3:47 a.m., exposed the gap between American promises and American capabilities. Institutional investors discovered that the safe haven they had relied on for generations was backed by digital accounting rather than physical assets. The response has been rational, coordinated, and devastating to American monetary supremacy. They are abandoning the dollar not through panic or political hostility, but through careful analysis of risk-adjusted returns in a world where American government promises can no longer be taken at face value. The institutional exodus is accelerating as word spreads through professional investment networks. Portfolio managers who missed the early stages of dollar abandonment are under pressure to catch up with their peers who began rotating assets immediately after the Treasury delivery failure. Network effects are amplifying the institutional flight. As more pension funds, insurance companies, and sovereign wealth entities reduce dollar exposure, the remaining institutions face increased risk from being the last holders of depreciating dollar-denominated assets. The institutional herding behavior is accelerating through professional investment conferences, where portfolio managers are sharing strategies for dollar diversification and comparing notes on successful alternative asset allocation. The American Society of Pension Professionals reported this week that over 80% of their members are actively exploring non-dollar investment strategies. Insurance industry conferences are dominated by discussions of currency risk management and alternative reserve strategies. Major reinsurers are warning their clients that policies denominated in dollars may face coverage limitations as currency instability increases. When the insurance industry starts questioning the stability of the currency they operate in, systemic risk becomes operational rather than theoretical. The Federal Reserve's settlement system failure lasted 14 seconds, but it triggered institutional behavior changes that will reshape global monetary relationships for decades. The quiet abandonment of the dollar has begun, and it cannot be reversed through monetary policy, diplomatic pressure, or political intervention. Institutions are voting with trillions of dollars in capital flows. Their vote is clear. The dollar system no longer deserves their confidence. The exodus is quiet, systematic, and unstoppable. The monetary order that has existed since 1971 is ending not with dramatic crashes, but with sophisticated institutions simply walking away. The trigger has been pulled. The institutional abandonment is operational. The only question remaining is how quickly American policymakers will recognize that their monetary supremacy has already ended